Good morning, everyone. My name is Carol Comerton-Ford. I'm a Professor of Finance at the UNSW Business School in Sydney and also an academic advisor to the Plato Partnership. In this session, we have two great papers for you, one on order exposure and one on short selling. Just a reminder about the format for the sessions. So each paper will have about an hour. We'll have a 30-minute presentation. I will take a break halfway through that presentation if there's questions on the chat coming through that need clarification. If not, the presenter will continue through to finish their presentation. Then we'll have a formal discussion. So an academic assigned to provide us some big picture thoughts on the paper and some of the implications from a policy point of view and how the research can be enhanced. And then we'll spend the last 15 minutes answering your Q&A as they come through the chat. So please send through your questions as they come to you. And I will also, if time permitting, give the presenter an opportunity to respond to the comments from the discussant. So the first paper that we have for today is a paper titled Order Exposure in High Frequency Markets. The paper is written by Buti Chakrabarti, Terry Hendershot, Samarpan Nawn, and Roberto Pasquale. Our presenter is Samarpan. He's an assistant professor at the Indian Institute of Management, and I'll hand over to him to give his presentation. If you want to go ahead, Samarpan, and share your slides.
Yeah.
Terrific, go ahead.
Okay. Good morning, afternoon, or evening with respect to wherever you are. I feel very privileged to present our paper, Order Exposure in High Frequency Markets, in this Plato conference. I'd like to take this opportunity to thank the organizers and especially Professor Comerton-Ford for this wonderful opportunity. My name is Samarpan Nawn, and I am an assistant professor of finance at the Indian Institute of Management, Udaipur. This is a joint work with Buti Chakrabarti, Terry Hendershot, and Roberto Pasquale. What is this study about? This paper deals with two fundamental and timely topics in market microstructure research: high frequency trading and hidden orders. Now, why do we say timely? Because while on one hand, HFT's contribution to trading volume has been increasing over time, and currently more than half of all volume is attributable to HFT in developed markets, on the other hand, hidden volume share in total trading volume is also on the rise. According to the Securities and Exchange Commission, hidden volume's contribution to trade has increased from 15% to over 30% in the US between 2012 and 2018. In this paper, we examine how high-frequency traders and algorithmic traders in general contribute to the pre-trade transparency by studying whether, how, and why HFTs use hidden limit orders in modern lit equity markets. We know very little from the literature on algorithmic traders or high-frequency traders' use of hidden orders. As many of you may know, a significant fraction of the liquidity supplied in modern financial markets is hidden. Now, part of this dark liquidity is provided by off-exchange fully opaque trading platforms, such as the so-called dark pools. Our focus is on the public exchanges, which are a priori highly pre-trade transparent. Interestingly, these public exchanges also contribute to dark volume by allowing hidden orders. As I stated earlier, 30% of the trades in US lit markets involve hidden volume. And according to our own estimates, based on the limit order book of NASDAQ, near the best quotes, 30% of the book is hidden during ordinary volatility days. But this percentage peaks to 50% during high volatility days. Hidden orders can be fully hidden, as in North American markets, or they can be partially hidden, as in Europe or Asia. In the latter case, they are known as iceberg orders. In case of iceberg orders, a minimum proportion, usually 10%, that has to be displayed while submitting the order. In this paper, I will discuss all results based on iceberg orders. However, I have some robustness and extra results from fully hidden orders that I can share with anyone who is interested. Now, common across stock exchanges allowing hidden volume, either fully hidden volume or partially hidden volume, is the so-called order exposure priority rule, by which hidden volume loses time priority or queue position against displayed volume. As a result, non-exposure comes with a delay cost. Hidden orders should take more time to execute than similarly priced displayed orders. The literature on hidden orders revolved around three important theoretical papers. One of those papers is a JFE paper by our discussant Sabrina Buti and her co-author Barbara Dendi. I must add here that we feel really privileged to have her as our discussant. The two other theory papers are respectively by Moynas 2010 and by Bulatov and George RFS 2013. The literature also includes a few empirical studies, most notable among them being Bessembinder et al. 2009 JFE. Now, important for the purposes of our paper is the fact that all the mentioned empirical studies use data for European markets from 2000 to 2003. Meaning that all evidence we have about hidden orders so far is from the pre-HFT era. And from then to now, markets have changed a lot. Traders are now starkly different in terms of their access to technology, algorithmic trading versus non-algorithmic trading. And within algorithmic trading, they are different in terms of motivation, agency algorithmic trading versus high-frequency trading. While agency algos execute customers' orders, HFTs are algorithms used for low latency speculation, market making, cross-market arbitrage, and other short-term speculative trading for proprietary accounts. Throughout the paper, our findings on hidden orders are distinguished between these three trading groups: HFT, AAT, and NAT. On most occasions, we find that the results for the non-algorithmic trading group matches the empirical finding of the papers from pre-algo or pre-HFT era. Meanwhile, the results for the HFT group are complete opposite to that of non-algorithmic traders. And on most occasions, the results for the agency algo traders fall somewhere between the results for high-frequency traders and non-algo traders. As it stands, we know very little about HFT's order exposure decision. So in this paper, we aim to fill this gap by addressing three primary questions relating to HFT's hidden order usage. First, we answer the whether question. We provide evidence for the first time in the literature that HFTs do hide orders, and in fact use hidden orders quite extensively. Secondly, we examine how efficiently HFTs use hidden orders vis-a-vis other traders. And we show that their hidden orders have a higher probability of execution, lower expected time to execution, and often lower implementation costs. And thirdly, we address the more difficult question to answer. Why do HFTs hide? Here we test for two possibilities. Number one, HFTs hide order to retain informational advantages. And number two, HFTs hide order to limit competition in liquidity provision. Now, empirically studying hidden order usage by different trading groups is challenging because publicly available trade and code data do not identify hidden orders prior to execution, nor do they identify who placed the order. We use proprietary data from National Stock Exchange of India that identify hidden orders and provide flagged information on the order submitter. The NSE is the fifth largest market in the world by number of trades. The NSE accounts for 70 to 80% of the traded volume in India. So analyzing NSE data gives the added benefit of observing a near non-fragmented market. Additionally, there are no dark pools in India. The NSE data furnish rich detail on trader accounts, using which we classify every order as coming from one of the three mutually exclusive trader types: proprietary algorithmic trader or high-frequency traders, other or agency algorithmic traders, and non-algorithmic traders. The NSE allows iceberg orders, and we can identify both the displayed and the hidden portions of each order. We focus on a market cap stratified sample of 30 stocks from the top 3 deciles where HFT activity is high and where we have enough observations to do meaningful econometric tests. Now that I have introduced the structure of the paper, let me take this opportunity to remind everyone that we are looking at 3 broad questions about HFT's hidden order usage. Whether HFT use hidden orders, how efficiently do they use hidden orders, and why HFTs use hidden orders. Let's start with the whether question. Do HFTs use hidden orders? And we find that yes, like all other trading groups, HFTs also use hidden orders extensively. About 9% of HFT's limit order submissions are hidden in our NSE sample of 30 stocks. Overall, algorithmic traders have a higher incidence of hiding their limit order than non-algorithmic traders. This is measured by the relative use of hidden orders. Next, we look at the aggressiveness of placement of hidden orders by 3 different trading groups. For this purpose, we build the NSE order book at every order submission time and identify the position of order placements at 4 levels relative to the top of the book. Price improving or better than the standing best bid or ask quotes, at the best bid or ask, up to the first 5 ticks from the best bid and ask or near, and rest of the book or far. Comparing across the first row, we find that while 52% of HFT's hidden orders are placed at better than the best quotes, only 16% of non-algorithmic traders' hidden orders are at the highest level of the LOB. Also, HFTs place very little, only 2% of their orders away from the top of the book, but the opposite is true for non-algorithmic traders with 38% of the orders at the far level. Agency algorithmic traders' hidden order placement generally falls in between the pattern for high-frequency traders and non-algorithmic traders. This is one of my favorite tables in the paper, and it shows the importance of analyzing HFT's hidden orders differently. Now, both theory and empiric suggest that when traders wish to trade large positions, they may hide their trading interest in order to limit the option value of their limit orders. So hidden orders are supposed to be large sized. However, when we examine the sizes of hidden vis-a-vis displayed orders placed by different trader types, we find that while high-frequency traders' hidden orders are predominantly in the smallest share size category of 0 to 50 shares, the pattern reverses for non-algorithmic traders with only 28% hidden in the share size category. Similarly, for displayed orders also, these traders show opposite usage patterns. High-frequency traders place only 5% of their displayed orders in the smallest share size category, but non-algorithmic traders place 65% of their displayed orders in this share size category. Even the average order sizes present the same picture. HFT's hidden orders are much smaller than their displayed orders, whereas for non-algorithmic traders, it is just the opposite. So, to take away from the weather section is that we find HFTs use HLOs extensively. They place their HLOs in the limit order book much more aggressively than non-HFTs or other traders, and their HLOs are much smaller than their own displayed limit orders. Maybe this can be a good time perhaps to take any clarificatory questions. So we can
no questions as yet, so just go ahead. Thank you.
Okay, thank you. Next, we focus on the second broad question: how efficiently do HFTs use hidden orders? We model this part of the investigation on Besembender et al., who find that hidden orders have a lower probability of completion and take longer to execute compared to similar displayed orders, although displayed orders incur higher implementation cost. We perform a likelihood of execution analysis using an ordered logic model, a time to full execution study using survival analysis, and an examination of the costs of execution as well as for non-execution by performing an implementation shortfall analysis. We estimate the likelihood of execution of hidden orders by contrasting high-frequency traders with other trading groups. And for this, we use a pooled ordered logic model. The dependent variable EXEC is an ordinal variable that takes three possible values. 1, if the order is cancelled before execution. 2, if the order is partially executed and then cancelled. And 3, if the order is fully executed. As explanatory variables, we include a dummy for hidden orders, dummies for traders, and interaction of trader type and order type dummies. As controls, we have several variables that capture the state of the order book, market condition, and order characteristics. In this ordered logic model, the negative coefficients on HFT and AT suggest that algorithmic traders' displayed orders are less likely to be fully executed than non-algorithmic traders' displayed orders. This likely reflects the algorithmic traders' higher cancellation to trade ratios. The negative coefficient on HLO suggests that non-algorithmic traders' hidden orders are less likely to be fully executed than their own displayed orders. But look at the patterns for algorithmic traders. It reverses, and most notably for high-frequency traders, as the sum of HLO and HLO HFT is greater than 0. Thus, high-frequency traders' hidden limit orders are more likely to be fully executed than their own displayed orders. Our findings therefore indicate that technology facilitates a more effective use of hidden orders, so that these orders, which lose time priority as per exchange trading rules, still have a higher execution probability. Notably, high-frequency traders' hidden limit orders are more likely to be fully executed than agency algorithmic traders' hidden limit orders, indicating that the motivation behind placing these orders also matter. To complement the previous analysis on execution probability, we examine the time to full execution of hidden orders placed by high-frequency traders vis-a-vis other traders using survival analysis. Survival analysis can accommodate an important feature of limit order execution time, the censored observations. An ordered, cancelled, unexecuted 30 minutes after submission apparently provides very little information about execution time. But the fact that it survived for 30 minutes in the book is useful information. Such information contained in non-executed orders can be used in survival analysis. We model the time to completion using the econometric model specified in Low, McKinley, and Zhang, and include our main explanatory variables of interest, the order type dummy, the trader type dummy, and their interactions. We recall that Bessembinder et al. Find hidden orders take longer to fully execute than similar displayed orders. In our table, non-algorithmic traders' limit orders conform to the finding of Bessembinder et al. However, look at the high-frequency traders. Here, the reverse is true, as the negative and significant coefficient on HLO-HFT offsets the positive coefficient on HLO. In panel B, we find that the estimated average time to full execution for high-frequency traders' hidden orders is significantly shorter among the three trading groups. Now we have seen that high-frequency traders manage their hidden orders execution more efficiently than other traders, such that they have a higher probability of execution and lower time to execution. But at what cost? We next estimate the cost HFT phase for their hidden order execution. For each limit order, either displayed order or a hidden order, we compute the perilled implementation shortfall metric, which is the sum of the effective cost of execution and the opportunity cost of non-execution. The effective cost component is just the difference between the average execution price and the mid-quote at the time of order submission. And the opportunity cost is just the foregone profits. From the first column, we see that the implementation shortfall for hidden orders placed by high-frequency traders is lowest among the three trading groups. While agency algorithmic traders also have a lower implementation shortfall than non-algorithmic traders, their hidden orders are not as effectively implemented as those of high-frequency traders. Now, to probe how high-frequency traders manage to achieve such reduced implementation shortfall for their hidden orders, we examine the estimates of two of its components, the effective cost of execution and the opportunity cost of non-execution. Comparing the effective cost across the three trader types, we find that high-frequency traders' hidden orders have the highest cost of execution. This is consistent with our previous analysis, which shows that HFTs HLOs are more aggressively placed in the order book than other traders' HLOs. The last two columns focus on the opportunity cost of non-execution. Here we find that high-frequency traders' hidden orders have a significantly lower opportunity cost of non-execution compared to the other traders, with a strong negative HLO-HFT dummy driving the results. Thus, although high-frequency traders face higher execution cost for their hidden orders, their non-execution costs are lower and much larger in magnitude, so that the opportunity cost effect dominates the effective cost, leading to an overall lower implementation shortfall. So the takeaway from this how section is that we find HFTs are able to use hidden orders much more efficiently than other traders, so that they have a higher fill rate or higher execution probability. Their hidden orders take less time to completely execute, and they have a lower implementation shortfall. We now reach the final and possibly the most important section of the paper, where we ask, why do HFTs use hidden orders? Now, because the decision to hide is only relevant for non-marketable limit orders, high-frequency traders' decision to hide should primarily relate to their liquidity provision or market-making strategies. Now, why would an HFT market maker choose to hide her trading interest? Market makers' profit depend on actual executed trading volume. So hidden orders' lower execution priority is actually costly to them. Now, one reason to accept a lower probability of execution is to preserve some informational advantages. Theoretical models do suggest that informed traders may hide orders to obscure their trading intentions, thereby reducing the expropriation of informational rents. Studies show that HFTs trades and orders do carry information. HFTs hidden limit orders could be motivated by small informational advantages arising from signals gleaned from order flow or from public news. Another possible motive for high-frequency traders hiding orders could be to reduce the competition in liquidity provision. If other traders competing to provide liquidity are aware of the size of high-frequency traders' order, they are more likely to offer a better price. So HFTs may hide order to avoid such situations. While HFTs may hide their orders to both conceal information and to reduce competition, these explanations have different empirical predictions. We first check if HFTs hide order to conceal information. If so, then their hidden orders should contain more information and impact the efficient price more than their displayed orders. Similarly, hidden orders should also have greater price discovery component than their displayed orders. To measure the information content, we calculate the permanent price impact of each trader type's order using an extended version of the VAR model as in Iceberg 1991. The model is defined in event time, where an event can be a limit order submission, a cancellation of a standing limit order, or a trade. Revisions that improve or degrade existing codes are treated respectively as a limit order submission or a cancellation. For each trader type, we consider both displayed and hidden orders, and we classify an order as an aggressive order if it is placed at or within the prevailing best codes. Now we check whether the permanent price impact of hidden orders placed by high-frequency traders is larger than that of their own displayed orders, which would suggest that high-frequency traders choose to hide their orders when they want to trade on valuable signals. However, we find that HFT's aggressive hidden orders have an insignificant long-term cross-sectional average price impact. This suggests that these hidden orders convey little information. Meanwhile, their aggressive displayed orders have a significant and positive cross-sectional average price impact. Thus, this test suggests that the HFTs do not use hidden orders to trade on information. In contrast, though, cross-sectional average permanent price impact for both agency algorithmic trader and non-algorithmic traders' hidden orders are positive and significant, suggesting that their hidden orders could be informationally motivated. These results also highlight the fact that while HFTs and AATs both share the same technology for trading, their choice of order exposure is contingent on their differential motivations to trade. As a second test of the information hypothesis, we estimate the information share of high-frequency traders' hidden orders vis-a-vis their displayed orders, as well as the orders of other traders. To do this, we use the approach proposed in Hasbrook 1995. Although much of the literature, including Hasbrook 1995 itself, uses this setup to estimate information share in a multi-market setting, this has also been used to assess information share across different trader types. We find that the information share for displayed orders is much greater than for hidden orders across all three trader types. Within hidden orders of the different trading groups, high-frequency traders have the lowest average information share at 6.13%, compared to 7.62% for agency algorithmic traders and 11.87% for non-algorithmic traders. Tests of statistical significance show that these differences between both high-frequency traders and agency algorithmic traders and between high-frequency traders and non-algorithmic traders are significant. Overall, the results in this table, as well as in the last table, highlight that HFTs hidden orders convey less information than their displayed orders or even the hidden orders of other two trader types. Therefore, we cannot accept the hypothesis that HFTs use hidden orders to trade on information. We come to the second possibility. Do HFTs use hidden orders to reduce the competition in the supply of liquidity? Here we test two propositions. Number one, do HFTs use hidden orders when the expected profit for market making is high? And number two, do HFTs use hidden orders for undercutting purposes? We first model HFT's decision to hide orders as a function of the expected market making profits. We use logistic model to evaluate a trader's decision of whether to hide or display a limit order. We approximate the expected profit of market making by the average realized spread over the past few trades. This variable is represented in the table as ERZ-SPR, and this is the variable of interest. For high-frequency traders, this coefficient is positive and significant, indicating that when the expected profit to market making increases, high-frequency traders are more likely to hide orders. By contrast, this is not true for non-algorithmic traders. In fact, it's negative, and it is much weaker for agency algorithmic traders. Thus, the competition for liquidity provision hypothesis finds some confirmation in our data. If high-frequency traders use hidden orders to aggressively compete to provide liquidity, then we should see greater use of these orders to undercut existing orders near the top of the book. We define an undercutting limit order as an order that is placed immediately after another submission on the same side of the market, comes in under 10 milliseconds of the previous order, and improves the price of the previous one. Univariate tests suggest that of the three trader types, high-frequency traders use the highest proportion of hidden orders to undercut. The results remain unchanged when we use a logic model that controls for market conditions and order attributes. We round out our investigation by showing how undercutting for liquidity competition affects high-frequency profit to market making. We estimate the pooled regression model where we regress the realized spread of each trade on passive trader type indicators and passive HLO indicators, and as well as the usual controls. Now, consistent with high-frequency traders placing hidden orders more aggressively than their displayed orders, we find that the realized spreads are larger for high-frequency traders' displayed orders than for high-frequency traders' hidden orders. Previous tables have shown us that HFTs hide orders in anticipation of higher realized spread, and they often do so by undercutting standing orders near the top of the book. This table indicates that this aggressive competition to exploit profit opportunities in market making ends up cutting into HFT's profits. Now, however, despite the fact that high frequency traders are more aggressive than other traders in placing their hidden orders, the wall tests show that when they manage to obtain significantly higher realized spread for these orders than other traders, agency algorithmic traders as well as non-algorithmic traders. Therefore, HFTs are able to extract higher rents than other traders when using hidden orders for market making purposes. So the takeaway from this Y section is HFTs HLO have a low information content, but HFTs are using HLOs to limit competition in liquidity supply. So to conclude, we note the following. HFTs make extensive use of hidden orders. Their hidden orders are aggressively priced and are of small size. Their hidden order usage is much more efficient than other traders, and their hidden orders do not carry information, while they use the hidden orders to limit the competition in liquidity supply. We end the presentation with a nice photo of an iceberg from the Arctic. And thank you all for listening to my presentation. Now I'm looking forward to listening to the discussion by Sabrina Buti.
Thanks very much, Samarpan. As already introduced, our discussant for the paper is Sabrina Buti. So Sabrina is a professor at the Université Paris-Dauphine, and she's worked extensively in dark trading and has published theoretical work on dark trading. So we're interested to hear her comments.
Thank you so much, Carol, for the introduction. And, as Samarpan did like a great presentation. So it's going to simplify my work a lot. So here it is. So let's get started. So it is a pleasure, to be here, and thanks for the invitation to discuss this paper. The paper is extremely interesting. So let me start my discussion by just, understanding why I found this paper really very interesting and opening a new, even I would say research area in HFT and dark liquidity. So just to give the big picture, we all know there have been two fundamental changes in financial markets in the last 15 years. One is market fragmentation and the rise of dark liquidity. And the other one is algorithmic trading, and more specifically, high frequency trading. Both changes have raised regulatory concern. And in the academic literature, there are quite a few studies on high frequency traders, and there are quite a few studies on dark liquidity. However, both changes happen nearly simultaneously, so it's very interesting to see how HFTs interact with dark liquidity. Unfortunately, there is very little research on this topic, not for lack of interest, but for lack of data, so especially on the empirical side. So this paper, in my opinion, really starts to fill this gap that we have in the literature by really linking what are high-frequency trader orders to the use of dark liquidity and the decision to hide orders. The setup of the paper, Samarpan did such an amazing job that I will go very quickly on this. So the research question is really to analyze the order exposure decision by traders. And really the point is to really differentiate neatly, not only between algo traders and non-algo traders, but even inside the algo traders category between proprietary algo traders, so basically HFTs, from other type of algo traders. So we have three main questions to answer. A little bit of perspective about the database. That's really the very strong, forward point of the paper is very detailed from the National Stock Exchange of India in 2013, so where HFTs were already fully developed. And just as a side note, is a market with very low fragmentation. At the time, NSE was executing roughly 80% of the total trading volume. An important point, iceberg orders were the only option to hide that was available to traders. So if we just quickly review the main results, but again, Samarpan did a great job at that. So I think for me, the most important takeout from the paper is that HFTs use iceberg orders very differently from other traders. So we really see that HFTs can, when facing the same order type than non-algo traders, are gonna approach the use of this order in a totally different way. So what we see in the paper is that HFT use small iceberg orders priced aggressively close to the best quotes, while non-algo traders tend to use large iceberg orders from the best quotes. The second takeout from the paper about how is, it's more of a confirmation. I mean, that's what I was expecting when I started in the paper. Well, HFT use iceberg orders more effectively than the other traders type. The last point is also very intriguing is why do we use iceberg order when we are an HFT? They seem to use this order to compete for liquidity provision and not to hide time-sensitive information. And the authors observed that, for example, they use more iceberg orders when market making profits are larger. They use them to undercut standing quotes. And this, of course, is a little bit in line with our theoretical paper with Barbara. And of course, it's very pleasing, like as a theorist one, you see that, people in the data find a little bit what you were saying. So what is the point here for me? The point is that dark liquidity in financial markets can take many different forms. So we have internalized flows, we have dark pools, and even when we look at dark liquidity on lit exchanges, there are different order types depending on the market. So we have iceberg orders, we can have fully hidden limit orders, and that's normally the case for US exchanges. And within the hidden limit category, often we have hidden midpoint peg orders. And I really feel that these type of orders are not exactly the same. I mean, in the iceberg orders, you show a part. In the hidden, it's totally hidden. You peg sometime to the mid quote. So we're not really talking of the same. So the focus of this paper is exclusively on iceberg orders. As I mentioned before, this was the only order type allowed on the NSE market. So I think a crucial question is, can we apply what we learn in this paper to other markets when the dark side, in a certain sense, is a little bit more rich? So if we just jump back in the past, Samarpan quoted this paper, and we look at Mario's paper with Kumar and Hank that was looking at Euronext Paris back in 2003. So, I like, it was really a different area for trading. You see that the use of iceberg orders was indeed very widespread on Euronext at the time. I mean, if you look here at the percentage of orders or percentage of order volume hidden, you get big numbers. And indeed, in line with what the authors find for non-algo traders, these iceberg orders were usually mainly to trade large sizes. You see that for large sizes, this really speaks up in terms of volume. So the question is kind of, okay, this was back in the time, so what about now? And now if we still stick to European markets, mainly because iceberg orders are used on those markets and not on US markets, the picture is rather different. So we still stick to France here in the middle. And if we look at how much volume is hidden on exchanges, we really have tiny percentages. So the point, the takeout from all this is to say that once we offer alternative ways to hide, traders prefer to opt for dark pools more than for hidden liquidity on the exchange. It is true that MiFID II restriction on dark pool trading may have changed a bit the picture compared to what I showed before that was referring to 2016. But, first of all, still lit exchange volume, as far as I know, did not rise that much after MiFID II. And second, midpoint peg orders seem to me a more natural substitute to dark pool than iceberg orders that, are a bit special in terms of characteristic. So I think, it would be great if the authors could ponder a bit, which result on iceberg orders would transfer to fragmented markets in which there are multiple ways to hide. And I think globally, there is really a need for an analysis of the link between HFTs and dark liquidity in a fragmented trading environment. The problem is that very rarely in the data, I mean, nearly never, we can follow HFTs, how they trade on both lit and dark venue, like we can in this paper. And this is really, an amazing contribution for me that this paper is, adding to the literature. We really can see how they behave, both, when they want to show their order and when they want to hide. As you know, 2 points a little bit more on the trading strategy observed. I was, very intrigued by non-algo traders. I know the focus of the author is HFTs, but at the same time, I think, for me, it's interesting to see how traders use iceberg orders in general. And I was surprised that they place often iceberg orders so far away from the 5 best quotes, roughly for 40%. The authors often refer to this paper by Marius and co-authors that was focusing on data from 2003 and say that this is in line from what they would observe at the time. I do not fully agree on this, because in their paper on Euronext, if we look at the least aggressive trader orders category 6 and category 7, first of all, category 6 seems the most used in terms of hidden orders, and actually is pretty aggressive. So these are buy and sell orders with limit price equal to the inside bid. And then category, the least aggressive category in their paper represent buy and sell order with limit price less than the inside. So we're not necessarily away from the 5 best quotes. So my impression is that now non-algo traders are going to put the orders even deeper in the book than in an era without in the period without HFTs. And I wonder why, because when you dig so deep in the book, do you still have this necessity to hide? I wish the authors it could add a little bit more of explanation in guiding the reader through what's going on. One last point that puzzled me a little bit too was and Samarpan highlighted this in his presentation, is the very, very small size of this iceberg order. So HFT, these small orders price aggressively close to the best quotes. I mean, small, really small. I mean, we're talking about 50 shares, right? That seems 0.50 seems very tiny to me. And I'm kind of wondering. I do understand that you use super small sizes when you can totally hide. But here, in a certain sense, I mean, does showing 5 instead of 50 really make such a big difference? I wish we were given a bit more of guidance. I mean, I don't know why, but I have this feeling that in a certain sense, HFTs are using iceberg orders, and you would expect them to use totally hidden orders just because, that's the only option they have, and there is not the possibility to hide fully. Because these super, super tiny orders in which in any case you're forced to show a peak puzzle me a little bit. So, it would be great if the paper could add, a little bit more of an explanation on that. Running out of time, so let me conclude. So to summarize, it's a very interesting paper. It's really the first one to link HFT's trading strategy and dark liquidity, and to show us that there are fundamental differences in how high-frequency traders and non-algo traders use iceberg orders. I'm sure you got this from Samarpan presentation. They did a super careful study. There are a ton of robustness tests that he did not even show. And I really consider this paper an important first step in understanding the link between HFTs and dark liquidity. Clearly, my hope for the future is that we will have databases that allow us to combine HFTs with all shades of dark liquidity and not just iceberg orders. Thank you very much.
Thanks very much, Sabrina. We have a few questions that have come through on the chat, so I'll go to those first and then give Samarpan a chance to reply. So the first question comes from PK Jain at Memphis and really goes to the data, I think. He says, do you know if specific informed traders within each category are marking all of their orders as hidden, driving all of the volume within a category?
If you could repeat it again. Yeah.
Sure. So do you know if specific informed traders within each category are marking all of their orders as hidden, driving all of the volume within a category?
Okay, so our database only classifies flags. Okay, so we either have a trader as a HFT or a NAT or a AAT. So it's not possible for us to identify different categories of HFT. So we don't have the trader IDs. So as such, I don't think that is possible, that we classify certain type of traders as informed traders and certain as uninformed. So that we can't do.
Okay, great. So keep the questions coming. The next question we have is from Bjorn Hagströmer from Stockholm University. He asks, regarding hidden HFT orders that are posted inside the NBBO, Did you consider the possibility that these hidden limit orders are used to extract information about the direction of the market? Being executed on these may give an important signal, early signal about imminent price moves. The fact that the HFTs have very small hidden limit orders is consistent with this.
Okay, again, our orders are all iceberg orders, so it's not necessarily we can relate it to the fully hidden setup. So it's not fully hidden. So whenever HFT posts something inside the NBBO, that becomes either the best bid or best ask. So it doesn't stay like inside the NBBO. So that now becomes the best bidder, best ask. And then we have, if it stays on for a while, then we for the econometric analysis, actually we include an order if it stays on the book for at least 2 seconds. That's not fleeting, okay? Or it trades by that time, then it's fine. Then we include it. Otherwise, if it's there for less than 2 seconds and it doesn't execute, so we remove that order from econometric analysis. So anyway, those orders will not be included in our analysis. But again, we have to keep in mind that it's not a fully hidden order setup. It's an iceberg order setup. So any order which is placed inside the NBBO cannot be hidden. It becomes the best bidder ask.
Yeah, but I guess even with that issue, do you see any evidence that they are using it to identify direction, price direction? That maybe after an execution, you see the rest of the order being cancelled.
Okay, so you are saying that if part of the, after the part of, so HFT places a small iceberg order and part of it executes, and then whether it's cancelled or not. No, we haven't done such an analysis. No, we haven't.
We have another question from Marios Panides. He says, is it so surprising that HFTs hide the orders when they undercut? The time to execution is the lowest anyway.
So the question is it surprising that...
Is it surprising that the orders are hidden when they're being used to undercut?
Okay, so we have the controls for aggressiveness, right? In the so when I explained the survival analysis table, so we have the controls. While I didn't show the entire controls, we have the order characteristics, market condition, every control. So within order characteristics, we have the order aggressiveness. That control is there. So that way we have control. But even after controlling for that, their hidden orders will take less time to execute. So that, I think that's a valid result which we have.
Okay, thank you. So we don't have any more questions for the moment, so I'll give you an opportunity to respond to Sabrina's comments.
Okay. So the first comment, so again, wonderful, thanks for the wonderful discussion. And I think 3 points which she has said, it will give us very good food for thought. So my initial reactions will be, she talked about many different types of dark. So can we apply our results to other markets? So is it generalizable or not? Yeah. So again, as she pointed out, in India, that was the only option to hide. Okay, so that was the only option to hide at that time, and I think till now there are no dark pools, so that remains the only option to hide. But what about other markets? So as I pointed out, most of the results for the non-algorithmic traders which we got matches the one which Bessembinder et al. Got for Euronext Paris. I think that gives us a bit of confidence in suggesting that whatever we have in whatever results we have for NSE can be generalized because there are no studies actually. So the only study we can go back to is Bessembinder's paper, which is 2003, and there everything was non-algorithmic. So so if we are to compare that result with our results, I think we have, obviously not everything will be exactly matching, but we have enough match with the non-algorithmic traders results. So this gives us some confidence. I also said that we have some different results from the fully hidden Nasdaq market. So there also we get an indication that high frequency traders fully hidden orders. Again, we can't mix and match fully hidden and iceberg, but having said that, there we also see their fully hidden orders are also small sized, and they are much more aggressive than their own displayed orders, as well as the orders of other traders or non-HFT. So these factors gives us some confidence to say that yes, our results can be generalized. Okay. So if I go to the next points, why would non-algorithmic traders place away from the top? Okay, again, this exact comparison can't be made, as Sabrina pointed out, that they bunch all the non-aggressive orders as category 7, as Bessemender et al. Do. So there we exactly don't know, but I would say, so non-algorithmic traders, when they are placing their limit orders and large size limit orders, there one of the concerns is to reduce the impact cost, right? When they have a big order, they want to trade, they want to reduce the impact cost. So price considerations would, and that's why they might be hiding. So price considerations may be one of the factors which, and no need for immediate execution. That might be one of the factors why they may be putting their orders a bit away from the.
You know, sorry. What I was wondering, you know, in the back of my mind when I put down this comment was, could it be that now it is a more dangerous war compared to 2003 for non-algorithmic traders? And that's why they start to dig even deeper in the book and farther in the book to hide, because hiding clause is now more dangerous than what it used to be in 2003. So that's, you know, what I had a little bit in my mind as a possible explanation for this behavior. But of course, you know the data way better than me. And so it was just, you know, a bit surprising. And I said, the only thing that is different between the two setups are really HFT. And this is true. So why now they go so deep? So I wonder if that could be an explanation.
Okay, sure. We'll think about that definitely. Yeah, and again, small iceberg orders by HFT. Okay, so you say why they might be posing such a small size. Again, from your theory papers only, I think we got this idea about this liquidity provision, right? The competition in reduction in competition or liquidity provision. Now there are many high frequency traders, and I don't know if smalls at the best bid, even there are maybe 50 high frequency traders posing a size of 5, that still gives a sizable number. So market participants can only see a total size, right? They for one individual trader, for me, whatever I am providing matters, but for market participants, the total size at the best bid matters. And I think there are enough high frequency traders who may be operating at the same time. So howsoever I can make my order that reduces the competition for liquidity provision, I would do that. So I think that would be one of the ways, because there is already competition. There is competition among the high frequency traders. There are many more high frequency traders. So I guess that could be one of the possible reasons. But again, we may think, again, these 3 are wonderful points. We will think about them more, and we can discuss again later.
Excellent. Thank you very much, Samarpan, and thank you also to Sabrina for your wonderful discussion. So we don't have any more questions. So we don't have any more questions for the audience. So we'll wrap up this session, and we'll start the next session on the hour. So 10 o'clock in London, and on whatever hour you're calling in from. So we'll see you soon.